Hello, traders. Gary Wagner here. Approximately 1 o'clock in Honolulu, 7 o'clock in New York on Friday. Happy Aloha Friday, as we say on the island. It is the 5th day of November, 2021, and this is the Daily Report for gold and silver. To say that this was an unusual week with a surprise ending, so to speak, when we had the European Central Bank on November the 3rd hold a press conference and say that their forward guidance is to leave interest rates where they are. The Bank of England made the same statement on November the 2nd. And of course, the Federal Reserve, which convened on Wednesday, also stated that they're going to leave interest rates intact, even though the level of inflation is extremely high. On top of that, today's jobs report was robust, above forecast by economists polled by Reuters. They were expecting about 400,000, and the fact is that approximately 531,000 Americans were added to non-farm payrolls. On top of that, the Labor Department revised the September numbers higher to show that there were 312,000 jobs added the previous month, which was initially reported at 194,000. It is quite obvious that market participants are focusing upon the rate of inflation rather than the economy beginning to really pick up, as seen through jobs added last month. Gold, which was flat on the day that the Federal Reserve made its announcement, had a tremendous gain yesterday and follow-through gain today, up $26.50, with December futures currently fixed at $1,820. Although a weaker U.S. dollar added to the expansion of gold pricing, it was muted compared to the buying force that came into the market with a vengeance over the last 2 days. The U.S. dollar index lost about 0.15% and is currently fixed at 94.20. In the last 2 days, we have seen gold rise tremendously. First, from approximately 1770 on Thursday, and then closing substantially higher at 1793 for a $23 gain. And then today, we saw gold open at 1792.60 and then close at 1820. Factoring in the last 2 trading days, in other words, from 1770 to 1820, we have seen a $50 gain in gold, and that gain has occurred during an odd period because, if you recall, on Wednesday, that's this large red candle here, the Federal Reserve came out and said that they're not going to raise rates, but they will begin tapering. Prior to that, European Central Bank agreeing with that market sentiment and both saying they were going to leave interest rates intact, and an exceedingly strong jobs report that came out today, we had this tremendous $50 rise in gold. What that tells me is that market participants are absolutely focusing upon the inflationary pressures rather than the economy, which is certainly becoming more robust and growing. Now that it's clear that market participants are clearly focused upon inflation over other factors within the economy, that tells me that our original forecast, meaning that I believe that we will challenge $1,836 by the end of the year, could absolutely come into fruition. That's not that far of a stretch. And I also believe, along with many other analysts, that the inflationary pressures that currently exist are a lot more persistent and will be sustained for a lot longer of a period of time, and are in no way transitory in the way the Federal Reserve and the European Central Bank are currently believing. That assumption, I believe, is wrong. And if in fact it is, we could see inflation continue to grow. If that is the case, our target for Q1, which is to challenge $1,900 per ounce, is certainly realistic and I believe quite achievable. Now, in terms of our shorter term view of the market, when we look at the current high today that came in, what we can see is that There is a series of tops that came in July. They came in just above 36, but there's really no area that on a technical basis indicates any kind of real resistance. The first level of resistance, I believe, has to be 1,835 to 1,840. However, beyond that, I believe it's got a clear and defined shot to at least challenge $1,900 per ounce. It is on days like this that I think a songwriter or poet can express what we are currently seeing in the financial markets better than any analyst. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.
Writers and critics who prophesize with your pen, and keep your eyes wide, the chance won't come again. And don't speak too soon, for the wheel's still in spin.